Listen, the IRS just changed the retirement tax rules for 2026. And if you don't know about these changes, you're about to hand thousands of dollars back to the government that you could have kept. We're talking up to $24,000 in deductions for individuals and nearly $47,000 for couples. $47,000 tax-free, gone if you don't understand what I'm about to tell you. But here's what nobody else is explaining. These deductions phase out. There are hidden traps that could actually cost you more money than you save. And I recently saw a 72-year-old retired teacher who thought he had everything figured out make one critical error that cost him over $4,000 immediately and triggered a Medicare penalty that's still costing him $300 every single month. I've seen every tax mistake imaginable. And what's happening right now with these 2026 retirement deductions is setting up millions of seniors to make catastrophic errors that will cost them tens of thousands of dollars they'll never get back. Before I show you the exact deduction amounts, before I reveal the trap that destroyed that teacher's retirement budget, I need you to do something for me right now. Hit that subscribe button, smash it. Because what I'm about to explain is not feel-good retirement advice. This is the brutal truth about tax planning that could be the difference between keeping thousands in your pocket or handing it to the IRS. If you're 65 or older or planning for retirement, you cannot afford to miss this. And while you're at it, hit that like button and drop a comment telling me your age and whether you've checked your Medicare premiums lately. I want to know if you're getting destroyed by Irma surcharges without even knowing why. Because that's exactly what happened to the teacher I mentioned. And I guarantee some of you are making the same mistake right now. Here's what just changed. The One Big Beautiful Bill Act completely rewrote the game for seniors in 2026. Most people assume taxes automatically go down in retirement. They don't. With these new brackets and deductions, the rules have completely flipped, and financial stress in retirement rarely comes from market returns. It comes from misunderstanding taxes, income planning, and timing. So let's start with the good news. The numbers you need to write down before tax season starts January 26th. That's days away. You need to know this now. Here are your baseline deductions. Single filers get $16,100. Married filing jointly gets $32,200. Head of household gets $24,150. Write those down. These are up from previous years, but that's just the foundation. Now here's where it gets really interesting, and this is where most people miss out on thousands. Are you 65 or older, or will you turn 65 by December 31st, 2025? If yes, the next 60 seconds could put thousands of extra dollars in your pocket. There's a brand new senior bonus deduction. If you're 65 or older by the end of 2025, you get an extra $6,000 deduction, $6,000. And if both spouses are 65 or older, that's $12,000 straight off your taxable income, $12,000. But this new bonus actually stacks on top of other deductions you already qualified for. Let me show you how this adds up, because these numbers stack fast and you're going to want to understand this completely. For a married couple where both spouses are 65 or older, here's what you get. First layer, standard deduction for married filing jointly, $32,200. That's your foundation. Second layer, additional age deduction that's been around for years, $1,650 per qualifying spouse. That's $3,300 total. Third layer, the new senior bonus deduction, $6,000 per person, $12,000 total. Now add it up, $32,200 plus $3,300 plus $12,000 equals $47,500. That's nearly $50,000 of your income that's completely protected from federal taxes. Think about that for a second. If you're a married couple bringing in $90,000 a year in retirement, $47,500 of it is completely tax-free. You're only paying taxes on about $42,000. That's massive. That changes your entire retirement tax situation. If you're single and 65 or older, here's your stack. Standard deduction $16,100, additional age deduction $1,250, new senior bonus $6,000, total shield $24,150. If you're single and living on $50,000 a year, less than half of it is even taxable. This is real money. This is tens of thousands of dollars staying in your pocket instead of going to the government. But before you get too excited, I need to tell you about the trap. This is critical. This is where thousands of dollars can disappear if you're not paying attention. Here's where it gets dangerous. These bonuses phase out. If you make over $75,000 as a single filer or $150,000 as a couple, the IRS starts taking that bonus back, and they do it aggressively. For every $1,000 you earn over the threshold, you lose $60 of the bonus deduction. Every 1,000 over equals 60 lost. And once you hit 175,000 single or 250,000 filing jointly, the bonus is completely gone, vanished. You'll still get the standard deduction and the age deduction, but that powerful $6,000 or $12,000 bonus, gone. And here's what most people don't realize. Losing that bonus triggers what I call the domino effect. And this is where people get absolutely destroyed. Let me show you with a real example. Meet Jane. She's 67, single, doing well in retirement, pension, Social Security, some IRA distributions. Her total income is $80,000. The phase-out threshold is $75,000. She's over by $5,000. Now remember the rule. For every 1,000 over the limit, you lose 60 of the bonus deduction. So Jane loses 5 times 60. That's $300 of her $6,000 bonus. You might think, okay, 300, that's not terrible. Wrong, dead wrong. And here's why this is so critical. That $300 reduction triggers cascading effects. It pushes more of your income into higher tax brackets. It increases how much of your Social Security gets taxed. Up to 85% can be taxable. And here's the big one. It triggers higher Medicare premiums through something called Irma. So that seemingly small $300 loss could actually cost you over $1,000 when you add up all the cascading effects. This is financial dominoes, one small increase triggering multiple larger increases. And this is exactly what happened to Robert, the retired teacher. Let me tell you about Robert, 72 years old. Retired teacher, solid pension, good Social Security, some savings, the kind of guy who does his homework and plans ahead. In 2024, Robert did something his financial advisor recommended. It wasn't bad advice on paper. It made perfect sense. He did a Roth conversion. He converted $120,000 from his traditional IRA to a Roth. Tax-wise, he paid the bill that year, wrote the check, thought everything was fine, case closed. That was his mistake. Fast forward to 2026. Robert opens his Medicare statement and nearly falls out of his chair. His monthly premium had jumped from $174 to almost $480. That's an extra $300 every single month. $3,600 a year just in Medicare premiums for the exact same coverage. How does a Roth conversion in 2024 affect Medicare premiums in 2026? Here's the trap that nobody explains. Medicare uses a 2-year look back to determine your premiums. That means for your 2026 Medicare premiums, the IRS is looking at your 2024 tax return 2 years ago. Robert's Roth conversion in 2024 pushed his income way up that year. Even though his income in 2026 was back to normal, back to just pension and Social Security, Medicare didn't care. They saw that spike 2 years ago and boom, Irma surcharges hit him like a truck. Now here's the part that makes me absolutely furious. Nobody told him about Form SSA-44. This is the form you file to appeal your Irma charges if you've had a life-changing event or income reduction. Robert could have filed this form, explained that the 2024 income was a one-time event from a Roth conversion, and potentially gotten those surcharges reduced or eliminated. But he didn't know about it. His advisor never mentioned it. The Medicare notice didn't explain it clearly, so he just paid the higher premiums for months, bleeding $300 monthly before someone finally told him. By the time he found out, he'd already paid over $2,000 in unnecessary premiums. Let me be crystal clear about this. If you sold property in 2024, converted a large IRA to Roth, took a big distribution, received an inheritance that created taxable income, sold a business, or cashed out stock options. Even if your income is much lower now in 2026, you could be getting hit with Irma surcharges, adding hundreds per month to your Medicare costs. And most people just pay the bill without realizing they can appeal it. They think it's automatic. They think there's nothing they can do. They're dead wrong. If you're already retired, lost a spouse, or had a significant income reduction, you do not have to accept these higher premiums. You need to file Form SSA-44 immediately. This form tells Social Security that your income has dropped and they can lower your premiums retroactively. Retroactively means they'll give you back money for the months you overpaid. This is one of those things that can save you thousands of dollars a year, but 99% of people have never heard of it. After I told Robert about Form SSA-44, he filed it immediately. He provided documentation showing his 2024 Roth conversion was a one-time event. Within 6 weeks, Medicare adjusted his premiums back down. He's now saving over $3,000 a year. That's $3,000 staying in his pocket instead of going to Medicare unnecessarily. The bottom line is this: that one-time income spike from 2 years ago could be costing you money right now, even though your current income is much lower. Check your Medicare premiums, look at your statements, and don't be afraid to appeal, because the government is counting on you not knowing your rights. Now let me talk about mechanics. Some of you are wondering, this sounds great, but how do I actually claim this senior bonus deduction? Good news, it's automatic. The IRS made this one easy for once. You'll file using Form 1040 or Form 1040 SR, which is specifically designed for seniors. When you fill out your tax return, you simply enter your date of birth. That's it. If you're 65 or older by December 31st, 2025, the IRS will automatically calculate your eligibility for both the age deduction and the new senior bonus. If you're using tax software, TurboTax, H&R Block, Free Tax USA, any reputable program, it should automatically flag your eligibility and apply all the deductions when you enter your birth date. The software does the math. You just need to make sure your birth date is correct. If you're filing a paper return, make sure you check the age 65 or older box. Don't skip this. Include accurate Social Security numbers. Make sure your birth date is clearly written. And remember, you don't need to itemize to get this deduction. Whether you take the standard deduction or itemize, you still get this bonus if you're eligible. The deduction will reduce your taxable income, which means you'll either owe less in taxes or get a bigger refund. And here's the timeline for getting your money. Paper filing, expect 6 to 8 weeks. That's the slowest option. Electronic filing, less than 3 weeks. Electronic filing with direct deposit, within 10 to 14 days potentially. Bottom line, file electronically with direct deposit if you want your money as quickly as possible. Why wait 2 months when you could have your money in 2 weeks? Now here's something really important you need to know. These federal deductions aren't automatically available in every state. States have to decide whether they want to incorporate these federal tax cuts into their own state tax codes. Some states do this automatically. Their tax code is linked to the federal code, but other states require official action to implement the changes. So you might get the federal deduction, but not the state deduction, which means you're still paying state taxes on that income. You need to verify this with your state specifically. Don't assume. Google your State Department of Revenue 2026 tax changes. Call your state's tax helpline. Ask your tax preparer specifically about this, because I've seen situations where people celebrate their federal tax savings and then get blindsided by their state tax bill because they didn't realize the deduction didn't apply at the state level. Know your numbers, know your situation. Now, let me give you the 4-step action plan that separates people who save thousands from people who overpay. If you only remember 4 things from this entire article, make it these 4 steps. Step 1, audit your income. Stay under those senior bonus limits if possible. If you're close to $75,000 as a single filer or $150,000 as a couple, you need to consider strategies to keep your income just below those thresholds. Maybe delay an IRA distribution, maybe time your capital gains differently, maybe hold off on selling that rental property until next year. Here's a specific example. Let's say you're at $74,000 in income and you're thinking about selling stock that would give you a $3,000 gain. Stop, wait until January, take that gain next year. Why? Because staying under that 75,000 threshold this year saves you way more than that 3,000 gain is worth. You keep your full $6,000 deduction. You avoid the domino effect on Social Security taxation. You keep your Medicare premiums lower. That 3,000 you gave up actually saved you 5,000 or more in total tax impact. That's strategic thinking. Step 2, diffuse the Medicare bomb. This is the Robert situation. Check your 2-year look back right now, pull out your 2024 tax return, look at your adjusted gross income, compare it to your current 2026 income. If there's a big drop, anything over $20,000, file Form SSA-44 to lower your Medicare premiums or where do you get Form SSA-44? Google it, print it, fill it out. Mail it in or take it to your local Social Security office. This alone could save you thousands. Remember, Robert saved over $3,000 a year after filing this form. That's real money. That's a vacation. That's peace of mind. Step 3, maximize your deductions. Whether you itemize or take the standard deduction, make sure you're getting every dollar you're entitled to. And if you're close to the itemizing threshold, you can bunch your deductions. What does that mean? Instead of making charitable donations every year, make 2 years worth of donations in 1 year. Same with medical expenses if you can control the timing. This way you itemize in the high deduction year and take the standard deduction plus your senior bonus in the other year. You're playing the game strategically instead of just letting it happen to you. Step 4, use income shifting strategies, Roth conversions during lower income years, but do them smart. Don't do what Robert did and convert a huge amount in 1 year without thinking about Medicare implications. Spread it out over multiple years. Convert just enough to stay under the thresholds. Qualified charitable distributions or QCDs. If you're over 70 and a half and you donate to charity, you can send money directly from your IRA to the charity. It doesn't count as income. It satisfies your required minimum distribution, and it keeps your AGI lower, donor-advised funds. These let you make a big charitable contribution in 1 year, get the deduction now, but spread out the actual donations over multiple years. The key is to be strategic. Don't just react, plan ahead. Let me give you a quick summary you can capture. For tax year 2025, filing in 2026, single seniors 65 plus get up to $24,150 in total deductions. Married couples with both 65 plus get up to $47,500 in total deductions. The new bonus deduction is $6,000 per qualifying person. Phase out begins at $75,000 for single, $150,000 for married. Complete phase out happens at $175,000 for single, $250,000 for married. And critical, this bonus expires after tax year 2028. You only have a few years to take advantage of this, so don't wait. This isn't forever. This is a limited window. Use it or lose it. Here's something that creates real urgency. Tax season starts January 26th. That's days away. But more importantly, if you're thinking about your 2025 tax strategy, you still have about 11 months before the year ends to make moves. This isn't just about filing your taxes correctly for 2025. It's about positioning yourself right now to maximize these deductions for 2026 and beyond. Check your income projections for 2025. Are you going to be over those thresholds? If so, what can you do between now and December 31st to get under them? That's the conversation you need to have with yourself or your tax advisor this week, not next month, this week. Pull out your income sources, pension, Social Security, IRA distributions, rental income, investment income. Add them up. Where are you landing? Are you close to 75 or 150,000? If yes, you have decisions to make. Let me bring this home. Taxes in retirement don't have to be complicated. but they do require attention. These new deductions could mean thousands of dollars staying in your pocket instead of going to the IRS, but only if you know about them and plan accordingly. Most seniors will miss this completely. They'll file their taxes the same way they always have. They'll take the standard deduction. They'll never realize they qualified for an additional $6,000 or $12,000 in deductions, and they'll overpay by thousands because nobody told them what changed. Don't be one of those people. Don't be like Robert before he learned about Form SSA-44, bleeding $300 a month in unnecessary Medicare premiums because nobody explained the 2-year look-back rule. Don't lose thousands because you went over the income threshold by a few $1,000s without planning around it. Now I need you to do something for me. If this information has opened your eyes to tax planning opportunities you didn't know existed, if you understand now why that retired teacher made such an expensive mistake, I need you to hit that like button right now. I need you to subscribe to this channel if you haven't already. And I need you to drop a comment below telling me if you've checked your Medicare premiums lately or if you're dealing with Irma surcharges. Let me know in the comments. I read every one and I'll point you in the right direction. Share this with any seniors in your life who need to know about these changes. Your parents, your neighbors, your friends. You could literally be saving someone thousands of dollars. I showed this information to Robert and it changed his entire retirement tax strategy. It could do the same for someone you know. This is information that makes you money. Tax strategies, retirement planning, Social Security optimization. Why wouldn't you want more of it? Subscribe and turn on notifications so you don't miss the next one. Tax season is here. Make it count. Be proactive. Take control of your retirement income. Don't let the government take more than they're legally entitled to just because you didn't know your rights. The $47,000 deduction is real. The traps are real. The Form SSA-44 appeal process is real. The income thresholds are real. Everything I've told you is documented and verifiable. The only question is whether you're going to act on it or ignore it. Choose wisely, because the difference between acting and ignoring could be tens of thousands of dollars over your retirement. And that's money you worked your entire life to save. Don't hand it to the IRS just because you didn't pay attention. Your move,